webinar on the new tax law. Our presenter today is Brian Reardon, who's the president of the S Corporation Association. Before joining the S Corp Association, he served as special assistant to the president from 2003 to 2005, working in the White House on the president's National Economic Council. Prior to serving at the NEC, Mr. Reardon served as staff director and chief economist of the Senate Republican Policy Committee. And before that, he'd also worked at the National Federation of Independent Business and on the staff of Senator Spencer Abraham, as well as Senator Bill Armstrong. Our speaker's presentation will be about 30 minutes. After that, will be followed by an opportunity to ask some questions of our speaker. As a reminder, if you'd like to ask a question, you can find the question tab on the right side of your dashboard. You can type in a question and we'll be happy to get that answered. And as a reminder, this webinar is being recorded and will be available shortly after its conclusion. I'll turn this over to you now, Brian.
Thanks, Dan. Really appreciate you guys having me on. Interesting times in the tax world, in the business world. Let's see, how do we advance this? There we go. As everybody knows, Congress passed the biggest tax code rewrite in 30 years. Some folks are calling it tax reform, some people call it a tax overhaul, but whether you like it or don't like it, it is easily the biggest rewrite that they've done since 1986 when they enacted the Tax Reform Act. The effort was driven largely by the desire to make the U.S. a more attractive place to do business. I think there was growing concern over the last 3 decades that while the U.S. business tax code in particular had been stagnant, other countries were busy improving their codes, cutting rates, making it more attractive to invest. So we stood still, the rest of the world got busy. As a result, our 35% corporate rate was way out of whack with where the rest of the world was, and we were seeing a lot of our businesses move operations, IP, and sometimes their entire corporate structures overseas through corporate inversions to avoid the U.S. tax and take advantage of those lower foreign tax codes. As such, successful reform would have reduced the cost of investing here in the United States, leveled the tax burden on investments and industries, leveled the tax burden between debt and equity, so it wasn't more advantageous to borrow as opposed to going out and raising capital to do an investment. And then finally, simplify. Just make everything easier, right? Here's an illustration of the challenge. This is a chart that our friends over at the Congressional Budget Office did a couple of years ago. I really like it because I think it gives you a real clear sense of what a mess the old tax code was. If you take a look, you can see these long lines. These are the effective marginal tax rates on a particular investment. And the left side there, the gray side, that's the C Corp world. The right side is the pass-through world. And you can see that, if depending on how you finance the investment and what exactly you are buying, there's a huge discrepancy between the effective rate on one investment versus another. It's all the way down here. Well, the top rate is for a C Corp. If they raise equity capital to make the investment, the top rate was 47%. So every dollar that you would get return on that investment, the government was going to take 47 cents. Down here, you can see the same C Corp. If they went out and borrowed to invest in something different, a different asset, then the taxpayer is effectively subsidizing them 42 cents for every dollar that you would expect to get from that investment. It's a huge discrepancy. It means that people were making decisions based on the tax code rather than on the business interests. And it created all sorts of variations in the economy that were not conducive to economic growth and job creation. So, done correctly, tax reform would do a couple things. One, it would shorten those lines. So rather than that big long line you see there, you'd have a much little shorter line. So it doesn't matter what you're investing in, you're pretty much paying the same effective tax rate. And then the second thing is you'd level them all out. So whether you're a C Corp or a pass-through, whether you're borrowing or you're raising equity capital, you're going to pay effectively the same tax rate regardless. That's what good tax reform should do, right? So how did the new law do? Well, for C Corps, it did pretty well. For C Corps, the bill offers a sharply lower top rate, 21%. That's down from 35. It balanced out the treatment of debt and equity, and we'll talk a little bit about that when we get to base broadening. On the international side of things, it gave U.S. companies territorial treatment, which means that they're no longer fully have to pay the full U.S. tax on their overseas income. So that's more in line with what other countries do to us. And then finally, there was quite a bit of simplification. They got rid of lots of deductions and credits, then they got rid of the corporate AMT. So the net result was a lower overall effective rate, more balanced treatment of debt and equity, and a more competitive and fair treatment of international income. So on the corporate side, you know, if the goal was to make the U.S. a better place to invest, I think that they succeeded pretty well. For pass-through businesses, the folks that I represent, the law is a little more complicated. Corporations got a 21% rate. For the top rate on pass-throughs these days is somewhere between 29.6 and something up in the mid-40s. Pass-throughs, for reasons that are still unknown to me, did not get the territorial tax treatment. They have to pay the top rate on all of their overseas income when they earn it. Simplification didn't quite extend to the pass-throughs. The individual AMT, the estate tax, and that NIIT, the net investment income tax that they enacted to help pay for Obamacare, those all still remain in place. And then finally, probably the worst thing about the bill for pass-throughs is that all of this is temporary. That 20% rate and whatever changes they made to the estate tax, et cetera, they all go away in 2026. So we're going to have to fight another fiscal cliff just like we did back in 2012. We have to look forward to one in about 8 years here. So lower rates for many pass-through businesses, but it's also accompanied by lots of complexity and lots of uncertainty. And the temporary nature of the new deduction, as I said, creates all sorts of challenges moving forward, both for business planning right now, trying to figure out, okay, how do I plan the next 10 years? How do I plan when I know that the tax rules are going to change in 8 years? How do I plan for that? And then, of course, the fact that we face another fiscal cliff starting in 2026. The centerpiece of the pass-through provisions is a new pass-through deduction. So the new law combines this new 37% individual top rate. So they lowered the top rate. It used to be 39.6. It's now 37%. And then they combine that with this 20% deduction. So if you take 20% off of 37, you end up with an effective tax rate, top rate of about 29.6%. Now that's just for some pass-through businesses though, because they don't extend that 20% deduction to all pass-through income. For all owners, there's a reasonable comp standard. For the first time, they've codified the reasonable comp standard. They apply it to S corps and partnerships. So the idea is that if you run a business and you work there, you have to pay yourself reasonable wages and you have to pay individual rates for those reasonable wages. Everything else, the remainder, that's profits, and you get to use the 20% deduction about that. Then the second set of guardrails are for owners above an income threshold. And in this case, it's $315,000 for a couple filing jointly. If you're above that threshold, then there's these two other guardrails apply. First, specified services businesses are excluded, as are businesses where their principal asset is the reputation or skill of a single employee. Specified services businesses are things like accounting, law, sports, entertainment, anything where you're effectively a professional and you're getting paid for your services. You don't get the deduction if you're above that $315,000 threshold. The second set of guardrails is a limitation tied to your employee payroll, or as an alternative, this combo platter of a payroll limitation plus your qualified investment. So you get the deduction, but only up to 50% of your payroll, or only up to 25% of your payroll plus this 2.5% return on your qualified investment. Sounds very complicated, right? It is very complicated. So how does it all work? Well, we'll give you two examples. First example is you've got an owner of an S Corp, owns 1/3 of the S Corp. It's a manufacturer, which means it's not a specified service business. So it should qualify for the deduction, but also means in this case, this person has income higher than the threshold. So they are going to be subject to these guardrails. So here's how it works. in this case, the owner A, they own 1/3 of the S corp, so their qualified pass-through income is $1,000, which means that you calculate your preliminary deduction. 20% of $1,000 is $200, but then you have to compare that to your guardrails. First guardrail is 50% of your employee W-2 wages. Well, here the W-2 wages are $900. Owner A owns 1/3 of the business, so his share is $300. You multiply that by 0.5, and you get $150. So the limit here for the deduction for owner A is going to be $150, which is less than the $200, which means that he's going to get less than the full deduction. As an alternative, you can also calculate this alternative guardrail, which is 25% of wages plus 2.5% of your qualified capital. Qualified capital is $10,000. 1/3 of that is $3,333. You can see the calculation here. He ends up with $158. So the alternative guardrail is slightly higher than the first guardrail. He's going to have to take $158 of deduction, not the $200 that he ordinarily would get. So the net result is that instead of getting a 29.6% effective tax rate, he's actually subject to a 31.2% tax rate. So this is where it gets real complicated. People say, well, you get that 20% deduction. Well, not everybody's going to get it, and not everybody's going to get the full deduction. It really depends on your particular facts and circumstances. Extremely complicated. Here's a second deduction or example. In this case, owner B is below the income threshold, and he's an accountant. His business has $1,000 of income. He has no wages. He's got no employees and no capital. Basically works out of a home office, something like that. He is a specified service business as an accountant, but because he's below the threshold, those specified service limitation, the W-2 test, all that stuff does not apply. What does apply is this newly codified reasonable compensation standard. So what owner B must do is, one, pay himself competitive wages, and then two, whatever the remainder, so whatever his income is, he's got to pay himself competitive wages. Whatever the remainder is, he can apply the 20% deduction against that. Again, not what's being talked about in the press. There are limitations. This person gets the deduction, but only to a certain extent, only to the amount that his business income exceeds his reasonable compensation. So that's the good stuff. That's the deduction. And as you can tell, it's kind of complicated. Treasury right now is working through all sorts of rules to make sure that people understand how to calculate it, particularly that provision about the skill and reputation of the owner or employee. That's going to be something very interesting to see come out. So the flip side of the tax bill is that in addition to the 20% deduction, there are also a number of base broadening provisions that apply. The larger provisions that apply to both C Corps and S Corps are, one, an interest expense deduction limitation. There's a limitation of your interest expense that cannot exceed a 30% threshold of what is first your earnings before interest and taxes. And then after 5 years, it's your EBITDA, right? Your earnings before interest, taxes, depreciation, and amortization. Bottom line is that for companies with high levels of debt, that limitation is going to kick in. It's going to limit their ability to deduct, which is going to raise their effective tax rates. For manufacturers and producers, you also lost the 199 deduction that we enacted back in 2004. Some of the provisions apply to pass-through businesses only. First, you have the loss of the state and local income tax deductions. For businesses operating in states with high individual income taxes, this is a really big deal. We'll talk about that a little bit later. And then second, they came up with a new pass-through loss limitation. For businesses where they have multiple entities, where the owner has losses of their active business income, it used to be that you could take those losses and apply them against your wages, apply them against capital gains. You could use them to offset other forms of income. Under the new law, you can't do that anymore. If you have active losses, you have to wait until future years where you have active income, business income, in order to offset those losses. It's a big change, raised a lot of money. It's not something that got a whole lot of press. Those are the base broadening provisions, at least the big ones. There are more. But the bottom line is that all the base broadening is going to hurt S Corps and pass-throughs more than C Corps, since the marginal rate for pass-throughs is so much higher. So for instance, if you lose $1 of a $1.99 production deduction, right, for the C Corp, that's going to cost you 21 cents because their marginal rate is 21 cents. For an S Corp, it's going to cost a low of 29.6 cents, could be something around 40 cents, could be higher depending on that particular S Corp. So all these base broadening provisions, even the ones that affect both C's and S's, they're going to affect pass-throughs more simply because the marginal rate on pass-throughs is higher. The combination of the limited deduction, the loss of the state and local income tax, the retention of that Obamacare 3.8% tax, it creates this dynamic where you have a remarkable variety of top rates applying to pass-throughs. And in this chart here, you can see that if you are, say, an accounting firm and you're an owner who doesn't actually work at the firm, doesn't materially participate, and you're in a high income tax state, you're going to pay a high of 44.8% marginal rate. That's an actual tax hike over what the law was last year. So that person is going to face a slight tax hike under the new law. Compare that all the way down here to, say, a non-specified service business, say you're a manufacturer, you work at the business, and you're in Wyoming or Florida or Texas where they don't have an income tax, then you're going to pay a low of 29.6. You're going to get the advertised rate. So again, the complexity and the variation of outcome in this bill is particularly remarkable, especially if you're a pass-through business. So during the consideration, it's time to blow our horn a little bit. S Corp worked with our friends at the American Supply Association, with Dan, with a bunch of other trade associations to try to improve the bill. And I think we were successful at significantly improving the bill, particularly thanks to the efforts of Senators Johnson, Daines, Inhofe. We were able to make significant changes in the Senate. We got an increased pass-through deduction. We got a lower top rate. We preserved the IC-DIS benefits for folks who export, and we expanded the deduction to include trusts and estates. So for many family businesses, you know, you're planning for succession, you've got one generation taking over the business from another, chances are that much of your stock is held in trust. Well, a first Senate bill did not allow for trusts to get the deduction. At the end of the day, they did, thanks to the work of all of the trade associations, including the ASA that we work with here. To give you an idea of the improvement, here's a little table. I won't go through the whole thing, but you can see this little part right here. The first column, the effective rate, the old effective tax rate for pass-throughs was about 44.6. Under the original Senate bill, it was 41.8. That's before a lot of the base broadening was taken into account. Under the final law, and the one that we worked to get, it was all the way down to 35.2. And you can see that compares to C Corps with an effective rate when you include both sides of the tax, both the shareholder and the entity level tax, of about 26%. So we're still not quite at parity with the C Corps, but the resulting bill was significantly improved over where it started, thanks to the work of all the folks that we work with in our pass-through coalition. So that's where we're at. That's kind of the broad strokes, what the pass-through community is facing this year and beyond. In terms of our advocacy, we continue to have lots of concerns and lots of challenges with the new law. Here are the top 5. One, the 20% deduction is unstable in the sense that the rules are complicated. It's really not sure how a lot of these guardrails are going to work, right? So, and it falls well short of parity. We did a long list of technical concerns. The link is here. Dan has this PowerPoint, so if you would like the PowerPoint and you would like the list of technical concerns, you can click on it there, or you can go to our website and find it on our website as well. But the bottom line is we're working through a long list of things that need to be fixed in this bill. Second priority, concern, S Corps precluded from deducting SALT. As I said, in states where you have a high individual tax rate, that's a big deal. California, the individual tax rate is 12%. Well, if you take 37% of 12%, you're talking about an effective increase in your tax on your business income of about 5 percentage points. That's the difference between having a corporate rate of 21% and a corporate rate of 26%. It's a big deal. The international provisions preclude or exclude S corporations and other pass-throughs. You don't get the 20% deduction on international income. All that territorial stuff does not apply to S corps and partnerships. Not really sure why, but they did. So that's an issue that we're going to continue to work on. The Obamacare tax, the 3.8% net investment income tax, remains in place. We're going to continue to highlight the fact that that needs to go. And then finally, this is the big daddy, all the pass-through provisions are temporary. They all go away. So at the end of the day, the corporate stuff's permanent, the pass-through stuff's temporary. That's just not sustainable, and we're going to have to work to make sure that that gets fixed in the coming years. Right now, in the next few months, we've got two challenges, and I'll just focus on these two for the remainder of this call. Priority one is something called grouping versus trader business. This is an issue that can be dealt with immediately. It's something that can be dealt with through regs as the Treasury Department goes about implementing the new law. Challenge is fairly simple. We can talk about it. The new deduction is located in Section 199 Cap A. It uses the term trader business as the basis for calculating the deduction. The challenge is that it doesn't define the term. The term has been used in the past, and it's frankly never been defined in statute, nor does it address the question of businesses with multiple separate entities. And I'm guessing that a lot of folks on the phone, if you take a look at their business, it's, from a superficial point of view, it's one business, right? But when you get into the legal structures, it's actually multiple businesses. So the question is, combination of this deduction plus all those guardrails, how do you go about calculating the 20%? At what level do you calculate the 20%? And this is a pretty big deal. Here's a little graphic to show you one of the challenges. So in this graph, this is a fairly common structure where a company is divided up into two. Company A houses the operating company. Company B houses the real estate. As I said, from a superficial point of view, it's all just one company. Legally, it's divided into two. Company A has the operations employees. Company B has the capital assets. Challenge is that if you separated them out and you had to deduct or calculate the 20% at the company A and then 20% company B, you're going to get a smaller deduction than if you're allowed to pool those two companies together, aggregate them together, and calculate it as a single whole. Here's a little table that shows you the difference. So company A, that's the operating company. You can see they get the full deduction. Their effective rate is 29.6. Company B is the capital or the real estate company. It does not get the full deduction. Its effective rate is significantly higher. You average them out and you're still looking at about a 32% effective rate. That's 2 or 3 percentage points higher than what they should get. However, way over on the right, the fourth column, if you allow for grouping, then you can see that the company as a whole gets that effective rate of 29.6, what they were advertised, and frankly, what they should get. This is a real company, it's operating, it's got employees, it should get the deduction. And by grouping, you get the deduction. So we're working with our Main Street Coalition. You can go to their website, it's Parity for Main Street Businesses. The ASA is a member, as are a lot of the other trade associations around town. We are working to make sure to highlight this issue with folks on the Hill, folks over at Treasury. We just released a letter this week signed by 40 trade associations arguing for allowing for aggregation, particularly for more sizable pass-throughs. This is almost a universal challenge. And as I said, it's something that can be dealt with immediately through regulations as opposed to having to go through Congress and get a new law. It's a more sensible way to calculate the deduction. And it's also a way to ensure that real businesses, real employees, real investments get that deduction that was advertised and that they were promised. So that's priority one. Priority two, pass-through businesses and the state and local tax deduction. As I mentioned, the new law eliminates the deduction for most state and local income taxes paid by pass-through businesses. And again, it's kind of complicated, as are many things in this law, but the simple way to think about it is if the tax is paid at the entity level, at the business level, like a sales tax or a property tax, then you can deduct it. If it's paid by the owner, like income taxes usually flow through to the owner and then they pay the income taxes at the shareholder level, it's not deductible. The challenge for us is that most states impose an income tax, and most of those income taxes flow through the shareholder. The vast majority of businesses out there are paying their business taxes at the shareholder level, which means that they're not going to be deductible in the future. As I mentioned before, this is a big deal. It can be a significant increase in the effective rate on businesses, particularly in states with really high income tax rates. So to address this inequity, we've got a two-step plan. Step one, work with Friendly Hill offices and our association allies to get legislation introduced. C Corps continue to deduct state and local income taxes, so should pass-throughs. Second, we're going to work at the state level to get them to adjust their rules. If taxes paid at the entity level are deductible, then businesses should be given the option, and I emphasize option, of paying tax at the entity level. Then they'd be deductible. They would no longer lose that deduction as they would under the current status quo, right? In recent weeks, we've been successful at getting this idea pushed around. Our friends in Connecticut have embraced the approach. The plan would, one, allow an election to impose a tax on pass-through businesses equal to the individual rate, okay? And then Connecticut, it's 6.99%, so it's a significant tax. Two, the pass-through owner would get a refundable tax credit equal to the tax that the business paid so that they're not getting double taxed. And three, it includes rules so that for shareholders of out-of-state companies, they get those same credits, Connecticut recognizes them. So that people who own pass-through businesses in other states that embrace this approach, you're not getting double taxed if you live out of state. It's a pretty simple 1, 2, 3 plan to reinstate the deductibility of the state and local income tax. To give you an idea of what it means in Connecticut, you can see under prior law here that if you had an S Corp in Connecticut and you made $100, you would pay the tax, but you pay it down here at the shareholder level, which means that it reduces your federal income tax because it was deductible. Your income for federal purposes goes from $100 to $93.01. And then you apply the tax rate, and you can see the effective tax rate for that business is 36.83%, right? Which, is the old rate, 39.6, right? Under the new law, where you don't get the deduction, you can see here that you still have to pay that Connecticut tax of $6.99, but you don't get it deducted on your federal income taxes. So your federal income is still $100. And then you take that 37% rate, which is lower, right? But you're taxing a higher base, the $100. Your new tax is 39.8%. It's actually higher than what you paid under the old rules. In this case, this business, by the way, doesn't get the 20% pass-through deduction. It's a specified service business. So, but the bottom line is, if you're a specified service business in Connecticut, you're looking at a tax hike. You're not getting a tax cut under the new law. So what our proposal would do is reinstate that deduction and make sure that that business doesn't pay a higher rate. In fact, they get a little bit of a tax cut. The rate would go down to the 37% rate, which is 2.6% lower than last year's law. So they would reinstate the tax cut that everybody was promised by reinstating the deduction of the state and local tax. So that's kind of the math. That's how it works. The Connecticut governors embrace the idea. What are the next steps? We're working with our Main Street Coalition to support and improve the Connecticut plan. We're working with attorneys to develop model language that can be used in other states. We're going to build out teams of businesses and advocates in other states to push this issue, and then highlight the effort in the press to make it make it kind of a national push. That's the idea. Bottom line is it's a win-win. This for the states. It doesn't cost them any revenues to do this, but it does make their state much more attractive to pass through businesses, so that you're no longer penalizing them by having this higher rate in the state and making it not deductible at the federal level. So bottom line, I think the tax reform is done. There are many, many challenges remaining. For S Corp, we'll be working with our friends at ASA and other allies moving forward. The two priorities, as I said, are one, making sure the new deduction is real, workable, sustainable, and two, level the playing field for pass-through businesses on SALT deductions. Those are the two priorities. There are many other things underneath those priorities, but I just wanted to focus on those two. Next steps, we're working with our Parity for Main Street Employers Coalition to educate Congress on the bill's realities and how it affects pass-through businesses. And 2, we're meeting with Hill and administrative offices to work through the implementation challenges and how to best treat pass-through businesses moving forward. So that's it. Really appreciate the opportunity to address you guys. I hope that was helpful. I know that there's a lot of stuff out there, so I tried to focus on the items that are really important to pass-throughs. And I'll turn it back to Dan, and happy to take any questions you guys have.
Thanks, Brian. And as a reminder, if folks have questions, they can find the question tab in there on the right side of their dashboard and type in a question so that we'll see that and get that answered. We've got a couple here for you, Brian. You mentioned before the process that the Treasury is going through now to implement that. Can you expand a little bit on that? On what is the timeline and process, and what can we expect to see in the near term as well as the longer term?
Sure. Yeah. So as you can imagine, when you write a big statute like this, there are a lot of areas that are gray areas, areas of uncertainty. There are also areas where Congress explicitly tells Treasury, you work out the details. Here's the broad brush, you work out the details. So that's what Treasury has to work through now. They put together a while back a list of priority guidance that they're going to do. So you have a sense of what they plan to tackle in the order. I expect that on the pass-through front, we'll see quite a bit of guidance and rules, proposed rules, particularly on this 20% deduction before August of this year. So I hope and I expect that they'll move very quickly. We've already seen some guidance coming out on particularly thorny issues. There were a couple issues that had to be addressed before March 15th. There was a March 15th deadline, so they got that taken care of. But the bottom line is that we're going to see a long stream of informal guidance and then more formal rules that go through the whole rulemaking process in the next 6 months. But I do expect that that's not going to be a complete list. That is to say that even if they get a lot of stuff out the door before August, there's going to be a long list of things that will take months and years after that to get completed. So we're going to be dealing with Treasury on an intimate basis, Dan, for quite a while here. But I think for calculating that 20% deduction and getting some of the rules about that, I expect to see something before August.
Great, thanks. Now another one here. Is there a concern or do we see an issue with folks just reorganizing as a C corporation?
Yes. I think if you took a sort of step back and looked at how well C Corps did versus pass-throughs, I would say that the new law tilts the playing field towards the C Corps. Not all pass-throughs are going to shift over to C. Certainly, I don't expect the majority of them, but there will be some companies that are under the new rules. C Corp is just a much more attractive structure. The rate's lower, the rules are a little more clear, and it's permanent, right? Which is a nice thing to do for planning purposes. You don't have to expect that, oh, I know that the rules are going to change here in the next decade. So I expect to see some pass-throughs and S Corps shifting into the C world. We've already had a couple members who have done that. They filed last week on March 15th to revert back to C for 2018. I expect to see a lot more companies do a wait and see kind of operation. There was a provision that I didn't mention that makes it easier to convert from pass-through S Corp partnership to C Corp in the next 2 years. You've got a 2-year window to do that. And if you do it in 2 years, you get more friendly tax outcomes in the out years. So basically, the new bill said, if you're an S now and you want to convert, do it in the next 2 years and you'll do better, right? So my expectation is that because 1, there's so much uncertainty now, but 2, you've got this 2-year window that a lot of companies are going to wait this year, see how the rules play out, see the guidance coming out of Treasury, and then make a decision in 2019 if they want to convert or not.
That actually sounds like the answer to a question that we just got posed. But if you want to expand any more, what other factors might you consider to change from an S to a C?
I think the two, I've talked to all my members because I'm very curious as to what their planning is, et cetera. And in fact, we have a survey that we put together that I'm happy to provide you, Dan, if you want to send it out to your membership. But send it out to our members to see where they're at. We're starting to get responses. But the two factors that stand out are, one, do you have the ability to not pay dividends, or do you have to pay dividends to shareholders now? And if you have to pay dividends to shareholders now, then that double tax continues to play a big role, and you're more likely to stay as an S Corp, even with the disparity in rates that the new law has. And the second question is, are you planning to sell the business in the next 5-10 years? Because if you're planning to sell the business, the rules continue to favor S Corps and pass-throughs over C Corps. The taxes when you sell are significantly lower, so that, if you plan to sell, you put up with a higher marginal tax rate now for the lower tax when you sell the business. Those are the two issues. One, do you have to pay dividends? If you do, you're more likely to stay in S Corp. Do you have plans to sell in the next 5-10 years? If you have plans to sell, or there's a possibility you might sell, you're more likely to stay in S Corp.
Thanks, Brian. Another one I have is, and this is sort of an inside the beltway question, but Congress has, it took them 32 years to get this done. So the chances of them fixing it seem pretty slim, or at least a heavy lift. They have, but they do have some opportunities coming up as far as technical corrections. And there's been some rumors of addressing a phase 2 of tax reform. What do you see coming over the horizon?
My crystal ball has been cloudy for the last couple of years, so I'm really bad at predicting things. I think the challenge that we face is, one, because they just adopted this bill, there's been a certain reluctance on the part of the tax writers to jump right in and address some of the concerns, technical problems, errors that were in the bill. I think that reluctance will go away over time. Over the next few months, they'll be more willing to come back and embrace it. Two, it's really not clear whether this bill that got enacted is similar to, say, the 1986 Tax Reform Act, which was, for many years, kind of the final word in taxes. They reformed the whole bill, the code, and then they didn't really make a whole lot of adjustments for quite a few years after that. Or is it more like the 81 Reagan tax cuts, where Reagan did the tax cuts in 81, and then they had a tax bill in 82, they had a tax bill in 84, and then they did the big reform in 86. Increasingly, you're hearing people say, this really wasn't tax reform. I mean, they cut the corporate rate, they did some reform things on the corporate side, but for individuals and pass-throughs, it's not really reform, and there is a door open for them to come back, say, in a year, 2 years, and address some of the issues that they left on the table. So bottom line is, I don't know where we're at. What I do know is that there are a lot of things that need to be addressed in this bill, either through regulations, and that's why we're working with Treasury, or by getting some of these things fixed, like making the deduction permanent, like eliminating the 3.8% NIIT, like fixing the SALT deduction, all those things, and we'll just focus on those. So we're going to take it one day at a time here, but it's entirely possible that, a big tax bill is coming. It could be next year, it could be the year after, but I'm certainly not going to close the door on that. But in the meantime, we're just going to focus on these challenges that are right in front of us.
Well, with that, looks like we're at the end of our questions. We really appreciate you joining us today, Brian, as well as those of you at your offices. As Brian mentioned, I have this PowerPoint available. Just send me an email at dhill@asa.net, and I'd be happy to send it your way. Thanks again, Brian.
Thanks, Dan. Really appreciate it.